Glenn Lambo. I'm such a degen.
Welcome back to Degenny from the blockchain, where we defy logic, and we're going to continue going through President Joe Biden's economic report from March 2023 and continue reading about what he said and his team said about crypto, and it's not good. It's not good. He's very negative on crypto, so let's continue our reading. All right, so we're in the section, there have been limited economic benefits from DLT technology. The ability of DLT to solve the difficult problem of ensuring that two parties that do not have a reason to trust each other can nonetheless transact securely is a notable achievement of computer science. This solution has led to excitement about DLT, with even some enthusiasm that this technology will change the way business is done. DLT and blockchain technology are not necessarily suitable for all applications. Some considerations have been proposed for successful blockchain technology applications. However, at its core, DLT is simply a database, and many proposed DLT-based projects do not actually employ decentralization, as discussed below. Some have sought to profit from the hyperbole of blockchain. It has become a common tactic for non-crypto related businesses to announce a pivot to blockchain to generate interest in a product or enterprise, blah, blah, blah. For example, in December 2017, a beverage maker named Long Island Iced Tea added blockchain to its name, though changing nothing substantive about its business, and its stocks shares tripled in value. Ultimately, 3 persons involved in the firm were charged with insider trading by the SEC, blah, 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 which alleged that these insiders used a pivot to blockchain tactic to increase the firm's share prices before they sold their stakes in the firm. Why is blockchain to blame for that? When clearly that is manipulation of the upper management within Long Island Iced Tea. I mean, isn't that clear? In addition, many prominent technologists have noted that distributed ledgers are either not particularly novel or useful, or they are being used in a cybersecurity expert. Used in applications where existing alternatives are far superior. For example, Bruce Schneier, a cybersecurity expert, has called crypto assets useless. Oh, okay. They're useless, I hear. And has noted that despite claims of being decentralized and trustless, blockchain-based applications are in practice neither often users access their crypto assets by going to a limited set of crypto asset platforms, and a small group of miners perform the majority of mining in most crypto assets, an activity that has costly implications for the physical environment, as discussed in Box 8.3. There's a whole other side to that. When it comes to the trustlessness of blockchain, Schneier notes that a blockchain does not eliminate the need for trust, but simply shifts the trust away from individuals and institutions to a technology, along with all of its features and bugs. That you have to start somewhere. That doesn't shy me away from using blockchain. James Mickens, a leading computer scientist who studies distributed systems, has stated that in addition to not actually being decentralized and trustless, blockchains are often a very poor fit for... Okay. They're misusing decentralized here. Decentralized means there's not one central entity that is verifying these transactions. That's all it means. So, blockchain is decentralized. At least a proof of work blockchain is decentralized. Because as long as you have more than one person verifying transactions, that means that there's not one central authority. That's it. So I disagree with this. This is primarily because the instant that the identity of a person or firm is needed, as is the case for supply chains, medical records, and land deeds, existing technologies can solve the same problem in a much more efficient way. For example, many of the cybersecurity benefits of an immutable, distributed blockchain can be replicated through existing features like tamper resistance, the ability to not change digital signatures at a later point in time, and non-repudiation, a receipt of a sender of information's identity that is delivered to both the sender and receiver of information, thus guaranteeing that both parties have processed the information. Proponents of blockchain technology claim that it will not only improve firms' performance, but also be the backbone of an entirely new internet. Web3, the so-called new internet, purports to retain all the privacy networking benefits of the earliest versions of the internet that existed roughly before 2000, often called Web 1, which featured decentralized, community-governed open protocols while keeping the high functionality of various features of Web 2, the current version of the internet, without the existing dependencies on large centralized firms like Google and Apple. I mean, just the fact that you're talking about Web3 and it's clearly defined, even in this document, means that it's coming and there is a Web3. Why are we trying to shutter all that in the United States? However, Moxie Marlinspike, the cryptographer and founder of the messaging app Signal, never heard of it, argues that the reason the current internet features so much centralization is because it makes things easier for two specific reasons. Well, I actually agree with that. It is easy and it's convenient because we as users of Web 2 internet are just giving up that power to these centralized entities. That's what it is. So Web 3 is decentralization, but Web 3 is ownership back to the user. That's what Web 3 is to me. I just use my Ledger Live and the keys are literally on a stick and I'm connecting it to the internet like I'm opening the door to access Web 3, and then when I'm done, I close the door and I lock it with my key that I hold. It's not on the internet. It is ownership. Ownership. Web 3 is ownership. No more centralized entities that are needed to do the actions that you want to do on Web 3. It's you and you're responsible for it. So, first, he argues that a decentralized internet would require individuals and firms to host their own servers. However, centralized hosting of servers can be done much more cheaply and reliably by large entities and therefore benefits from economies of scale. Second, he notes that protocols or the rules that internet systems run on are much more difficult to change than platforms. That is, centralized, non-open source protocols can be managed by a single entity as opposed to many. Right. Facilitating a wider variety of features that can change with much greater speed than if they were decentralized. No, not true. Or maybe that part is true, trying to make a change, but there's something called DAOs in Web3, and as far as I know, I haven't participated in any DAOs. You just put forth a vote, and then it's voted upon and then implemented, right? I mean, nobody's saying that that might be faster than just a centralized entity just making the decision and doing it. But the fact that there is decentralization involved is the power there. And nobody is saying that particular, or I'm not saying that's particularly faster. Maybe it's not, but it's more sovereign in that the people within that blockchain or ecosystem in that DAO have the power. That's the point. Marlinspike also notes that Web3 is already trending toward a centralized structure because of the ease of convenience that centralization brings, but in a much clunkier way than if traditional technology were being used. I mean, I've been in crypto since early 2021, January. I'm going on, 2.5 years in the crypto space. I just used Ledger Live for the first time, and I've educated myself enough to know, I didn't know how to use Ledger Live in Ledger Nano X, but I just figured it out. I mean, I plug it in, I follow the instructions. I'm familiar with recovery phrases, seed phrases, pins. I'm familiar with receiving and sending crypto. So is it more clunky off the front end? Yes, maybe, because you have a lot of learning to do as a noob. But now I feel fine sending money, copying addresses, looking at the address, the fees that are involved with gas. Like, these are all things that people will eventually become to know. So clunkier at first, but I don't think clunky later. And look, convenience is great, but if there's a few extra steps to go to protect yourself and your assets, I would do it. I don't need a ease, something easier to operate with while managing my funds. I'm fine with having it be a few more steps and be a little more clunky because what is it about? Is it about ease of use or is it about self-sovereignty and ownership and being in charge of your own money? Number two seems a lot more important than number one to me right there. Um, and as long as there is a way to do it, it can be a little clunky. It's fine with me because I'm sure it is. Like when you're doing something so big like that, like go talk to the centralized, companies that are doing this stuff right now in Web 2. They'll probably say it's pretty clunky on their end because they're doing everything on the back end. It's not just a drag and drop. So he specifically notes that once a distributed ecosystem centralizes around a platform for convenience, it becomes the worst of both worlds, centralized control, but still distributed enough to become mired in time. Top 10 derivative platforms by open interest. Okay. Risks of financial innovation. The risks of financial innovation. Let's stay in the olden days and not ask any questions or try to make things better. While the crypto assets ecosystem and its underlying technology introduce the potential for newfound efficiencies, efforts to challenge this basic economic principles have frequently resulted in financial calamities. The economist Hyman Minsky hypothesized that financial crises often follow a similar cycle whereby initially strong investments turn increasingly more speculative until a bubble bursts. Oh boy. 1992. They weren't talking about crypto in 1992. At least I don't think they were. And the bubble, that's speculative, right? We have seen use cases with crypto that are not speculative, but I won't argue that a lot of crypto is speculative, but I'm saying that at least when this is all said and done and crypto has been adopted and Web3 has been adopted, maybe there's only 20 or 30 blockchains that survive. And those are going to be what we use. Those are going to be your Amazons and your Googles and your Whole Foods and your Targets, Well, let's continue. But in terms of like utility in crypto and implementation, there would be no bubble, if it's implemented. It's just another technology. This isn't like... So bubble burst, yes, I get it. There's not going to be 10,000 crypto that survive. No, there won't be. There will be crypto that bursts, crypto bubbles that burst. But in terms of like the strong 30 to 50 blockchains that survive that can do everything that we need them to do, that's going to come. So yeah, I get it. Just the lesson here is not to put everything in crypto. And I agree, at least at this point, you still want diversification, but I wouldn't paint crypto like they are here in such a negative light. Further, Minsky stated that this repeatedly happens because regulators are initially vigilant in the immediate aftermath of a crisis, but as time goes on and the instrument of speculation changes, regulators take a less prescriptive approach to not harm innovation. According to Minsky, this relaxed regulatory environment invariably leads to another crisis. Indeed, other economists have argued that the most effective financial regulation has been introduced only after a crisis has occurred. And I'm not arguing with that. Just be very careful, Personally for me, for example, Glint, the Moonbeam network, beam swap, decentralized exchange on the Moonbeam network, it's like number 2,500 or somewhere in the 2,000s of crypto. It only has a market cap of like $500,000 or something. So I only put $300 in there. But if that gets a pump, to a 1,000x, which I'm not even expecting. If I can get a 10x out of that and pull out $3,000, I'd be ecstatic, okay? But, if it bursts, though, if that particular bubble bursts for Glint, the Glint token, I only lose $300, right? And that's manageable. So, this isn't about crypto, this harm and this potential, crisis and calamity that's highlighted here. This is for all investments, especially, it's for all investments, and especially for brand new technology like crypto. So, Yeah, like be smart, of course. We don't have to say that in a report that says crypto is bad. We should all know that as investors and as buyers of crypto that there's risk. So that's basically what this is saying. And again, smaller market caps that are highly, highly, highly unsure, I just put a few $100s in. And the upside is massive, and the downside is I lose 300 bucks. That's it. That's it. No harm, no foul. Minsky's theories became popular in the aftermath of the global financial crisis when complicated financial products involving mortgages that exacerbated the crisis were initially hailed as innovative, and individuals discussing the risks were labeled Luddites by prominent commentators. Minsky's writings, as they apply to past financial crises, may prove instructive for policymakers today. Fortunately, there has not yet been a systematic crisis caused by crypto assets, in part because they are not yet fully integrated with the rest of the financial system, giving policymakers time to act appropriately. The risks presented by crypto assets stem from excessive speculation, high leverage, run risk, environmental harm for crypto assets, mining, and fraudulent activities that harm retail investors and corporations. Because crypto assets appear to be here to stay, policymakers should consider these risks to avoid a Minsky moment caused by crypto assets. I like this line because crypto assets appear to be here to stay. That's something. Other risks from crypto assets. Some risks that apply to crypto assets require further examination. Many of these risks are not unique to crypto assets. Combined with innovative technology, they pose challenges for policymakers and regulators trying to minimize risks while encouraging responsible innovation. Yes. Well, this part of the report I am liking because they are saying crypto is here to stay, and crypto poses challenges for policymakers and regulators trying to minimize risks while encouraging responsible innovation. We want innovation. Stop pushing it out of the United States, or stop halting it, and try to find a way to implement this into our financial system. I like it. Leverage risks. Crypto asset derivative platforms where investors can buy and sell financial derivatives linked to crypto assets have seen substantial growth in the past 2 years. Top 10 platforms of crypto asset derivatives, which account for roughly 76% of all volume, according to the initial regulator. One of the largest platforms, Binance, refuses to provide adequate or reliable information in response to regulatory requests. Okay, I'll take their word for it here. Whatever. Exchanges frequently tout the high amount of leverage they offer clients, stating that investors can take up to 101 leverage. So they're saying derivative. I mean, I'm not a trader, and I'm certainly not a leverage trader. So, they're saying there's leverage trading in crypto, which, along with the volatility of crypto, is even more risky. So, I understand that. A relatively new application of DLT in financial markets where there is a relatively unknown amount of leverage is so-called decentralized finance. Woo! I'm going to like this. DeFi attempts to offer financial products such as loans on the blockchain through the use of smart contracts. Yes, it does. Because wouldn't you say that is a nice and quicker way to do loans and stuff than we have right now? And I don't think you can do a loan unless you actually have the assets initially. So you can try to get loans right now from the bank, and you're just putting your trust in all that process. But I think the only way to loan yourself a loan is by your own assets, right? So at least it's your assets that you're starting with. Yeah. The basic promise behind DeFi is to replace financial intermediaries, instead linking savers directly with borrowers. Okay, buyers and sellers, allowing them to save on the spread that traditional intermediaries charge for creating the match with software. Yep. I agree with this. Though DeFi applications claim to help broaden access to credit by decreasing intermediation fees, they create serious risks to investors and cause at least 2 risks for the broader financial system. the use of significant leverage, and the performance of regulated functions without compliance with appropriate regulations. Yeah, I mean, I'm not disagreeing with this. Maybe we shouldn't have so many. Maybe you only can take out a loan against your own assets. Maybe that's the answer. Because yeah, I mean, look, loans is debt. Loans equal debt, right? So that's never a good thing. And to do it in a very high and volatile market, yeah, that's very risky. That's very risky. I mean, this should be used as education, right? This particular piece in this document should be used as education, in knowing the risks of all this stuff, not just shutting it down because it's risky. That would make no sense. Because again, we would go through growing pains with technology, right? And just shutting something down because it's risky would not be the proper move. DeFi platforms acting as unregulated banks. I mean, they're not. They're not calling themselves a bank. The DeFi platforms are not calling themselves a bank. I mean, not in the term that it's being used here. Like, yeah, no. Broker-dealers, exchanges, and other entities subject to regulation should be operating in compliance with existing regulations and rules. That's what you think. And if that's the case, then why aren't you making these rules? That's the whole point. Like, I'm saying we as a crypto community, but let's say Coinbase, for example, has been asking for years for some sort of regulation and clarity on exactly what you're saying right here. So it's not like we're not asking for a few things of clarification. We are. And you're even saying in here, there should be. But why isn't there? DeFi lending platforms effectively receive funds from investors and use them to generate loans promising interest to investors. Promising? I don't know about you, but any DeFi project, I don't think I'm promised anything. I think I'm in a very risky environment. This dynamic inherently causes run risks, where more investors try to redeem more of their funds than the platform can accommodate at a given time, thus causing the platform to either suspend convertibly or fail outright. I think we're asking for you to regulate, platforms. But DeFi, no. No, it's about education. Centralization in centralized exchanges, yes. Please regulate those. But DeFi is more about education. Furthermore, DeFi presents the opportunity for synthetic leverage. Hey, you know what? I was involved with Freeway, which is a synthetic platform. Basically, it is you put your crypto or your cash on their platform, they take it, move it into cold storage, create a synthetic version of that, and trade, I believe, with an algorithm with the assets that are in that the cold storage wallet, and generate a return of synthetic value until you cash out. And they had between the volatility one day and a hole in their algorithmic system, they lost like 75% of their funds basically in the day, and that paused withdrawals. So the synthetic thing, yeah, I mean, it's literally not real, and you are giving up your you're giving up your funds for a synthetic version, so you don't have them anymore. So again, that's super, super, super risky. In terms of DeFi providing liquidity or something on a DEX, maybe that's a little less risky, but super risky nonetheless. But again, I think it's more about education and knowing your risks than it is to stifle innovation or to say something is bad and kill it. Investors can mask the true amount of leverage they are undertaking from the party from which they are borrowing. Yep. If DeFi were limited to small retail investors, the failure of a DeFi platform could still hurt these investors, but the shock could be relatively contained. Banking agencies issued a statement that expressed concerns with business models that are concentrated in crypto asset related activities or have concentrated exposures to the crypto asset sector. Price volatility. Most crypto assets experience substantial price volatility. Holding such volatile assets could present challenges for large financial institutions. It's hard to read, guys, on camera. Trying to go through it really fast, and for like the 5th video, I gotta be honest. Okay, as the volatility would lead to constant changes on the asset side of their balance sheet, this volatility in turn could increase funding costs for banks and other financial institutions, thereby requiring banks which fundamentally borrow so as to be able to lend to increase the funding costs, interest rates that they charge, leading to tighter credit conditions. What do the banks do? I mean, don't they do that? Currently, this contagion risk is relatively muted given that banks are limited in their ability to conduct crypto-related activities such as acting as custodians of crypto assets, holding crypto assets. All right, indeed, banking regulators such as the Federal Reserve have issued guidance requiring regulated financial institutions to inform the regulator before engaging in crypto asset related activity. Ouch. So the Fed is asking any financial institution to tell them that they are about to engage in crypto activity. Why? That's weird. But other less regulated financial institutions, such as hedge funds, are increasingly investing in crypto assets. I wonder why. Such activity of lightly regulated or non-regulated entity, like, why does everything have to be regulated? Again, maybe hedge funds should not go into an unregulated market because hedge funds are more or less in a regulated market. Maybe they should stay there. Maybe that's the framework. But in terms of an individual, they should be allowed to do what they want with their money. That's all. Such activity of lightly regulated or non-regulated entities can lead to liquidity spirals as described by these spirals occur when a dramatic crash in the price of an asset, such as a crypto asset, leads a hedge fund to be margin called, requiring the fund to sell off other positions to meet the margin call. If enough funds are exposed to the asset or assets with declining prices, then sell-offs could be broad enough to cause a deterioration in market liquidity. I'm looking at you, FTT and FTX. Illicit finance risks. Crypto assets are the standard form of payment extorted from victims of ransomware, whereby a malicious actor hacks an organization. Yeah, there's scams everywhere. Look at your spam folder in your email right now, and look how many scams are in there. There's scams everywhere. And yes, if something new like crypto is introduced, there will be scams in crypto. If there's some amazing new thing coming from Microsoft, I just use that as an example, like a new hardware, there could be a scam involved with that somehow. There's scams everywhere. There's certainly scams in the banking system, printing money. Crypto assets remove a critical friction in performing a ransomware hack because the attacker can demand that crypto assets be sent to a pseudonymous wallet instead of a bank account linked to a specific person. Yeah, attackers can more easily launder or obfuscate payments made to them in comparison with fiat currency. We're not arguing that. They do. It's easier to launder money, but you go after those people who are laundering money. How cool is it that I get to send currency from me to my family who needs it, or me to pay a friend for lunch right away? You can do it with Venmo, but in the background, it's taking 3 business days to move funds around and get it from one bank to another. What? How about near instant verification on the blockchain? One wallet to another. That's it. It's money. It shouldn't be that difficult. It's if I give somebody some water, I hand my water to them, they drink out of it. That's it. It doesn't have to be a third person. Importantly, like other financial assets, crypto assets can be misused for a range of illicit activities. Oh my God. Like cash can't? At least I can see on the blockchain where money went. If somebody outside right now decides to hand some cash to another person, that's not tracked anywhere. Why do we have to track things all the time? I mean, um, that's not what I'm saying. I'm saying why isn't cash tracked? If you're afraid of illicit activity or crime or some sort of scam going on, I can guarantee you that's happening in cash under the table and you're not seeing it. We're actually being transparent here in crypto where you can see all that unless it's a private blockchain like Monero. So we got nothing to hide. We're not trying to hide anything. Okay? You just think that we're all bad players here. Crypto assets have also been misused by human traffickers, by individuals exploiting children for sexual abuse, cash, and by drug traffickers and scammers. Cash, 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 fiat, dirty money. Also, it's happening there. My God. To fund the activities of rogue regimes, such as recent thefts by the Lazarus Group, which is affiliated by North Korea and to finance terrorist activities. You are weaponizing crypto here when it's the people behind these activities that you need to go after, not the crypto asset itself. Again, it's easier for me to move money from one wallet to another than it is to go to a bank and move money from one account to another. I can do it instantly on the blockchain, and I can appear to do it instantly on my banking app, but I know in the background it's taking days to get that done because there has to be all these verifications. Why? Shouldn't it just be money, one-to-one, move it from here to there? The other key illicit financing risks associated with crypto assets come from gaps in implementation of the International Anti-Money Laundering Combat, oh my God, AML-CFT standards. Okay, sure, whatever that's saying. Ransomware uses. As hacking to receive crypto assets becomes more widespread, more firms will attempt to insure themselves against these attacks by purchasing cyber insurance. However, the existence of such insurance may not eliminate the underlying problem. Yes, the underlying problem are those people. It's not the technology. It's the bad actors, for crying out loud, including yourself, man, government. Instead, may create an incentive for hackers to attack. Oh my God. They're saying that there's ransom attacks in crypto. I don't know about you, but every year or every seemingly 6 months at my job, I have to go through some ransomware cybersecurity training a couple times a year. The company I work at has nothing to do with crypto. So why are we talking about ransomware in crypto? Because criminals are trying to use crypto for ransom. Yeah. And that happens in the most centralized way too, in regular business and attacks. So I don't know why this is this is just risks in general of technology that's existed for decades and that's been developing, This is not crypto related. No. So let's finish up this series in the next video. If you have any comments right now, let me know below. And any commentary on my takes either, what I'm wrong on, what I'm right on, anything, let me know below. Let's have a conversation. Do your own research, of course, because this is not financial advice. And everything that you're reading here with me is something that you have to think about and how our government officials see crypto and make your own financial decisions. Thank you for watching. I'll see you, or you'll see me, in the final video in the series. Thank you for watching. Hey, thank you for watching to the very end. And before you go, please subscribe to the channel, crank up that like button, drop a comment and share the video. If you want to join me on the VEUIT platform, the Web3 streaming platform, I'm going to migrate all my content over there and create new content on the blockchain. My referral link is in the description below.